Good day, everyone, and welcome to Equilibrium's quarterly bulletin. My name is Methula Sikakana, and I'm the Business Development Manager at Equilibrium Investment Management. It is my great joy to be your host today. Thank you for taking time to join us today and for your continued support of our investment solutions. We have an exciting agenda. But before we delve into the session, let me first address a few housekeeping matters. We've applied for CPD points and expect to receive confirmation from the FPI in the coming weeks. It's important to please watch the full session and add your ID to the CPD section so we can verify your attendance. You may also view this event on this platform at any time until the end of June and still receive your CPD points. Our event platform automatically emails you your CPD certificates as soon as you've watched the full session. Lastly, please feel free to ask questions in the Q&A session and our speakers will either answer them live or get back to you after the event. Okay, let's kick off this quarter session. First up, we have our Chief Economist, Sanisha Prakisamy, and our economist, Tiamo Masike, who will unpack the crisis in the corridor. Sanisha and Tiamo, we look forward to your valuable insights. Over to you.
Thank you, Methula. Good day, everyone, and thank you for joining us. I am Tiamo Masike, economist at Momentum Group. At the start of the year, we framed 2026 as a year of cautious optimism. We were expecting easing inflation, lower interest rates, and a gradual recovery in global growth. 5 months into the year, and the landscape is a lot more uncertain with more downside risks emerging. A key shift has been escalating geopolitical tensions, particularly in the Middle East. As a result, financial markets are recalibrating expectations around inflation, interest rates, and economic growth dynamics. So in today's discussion, we will revisit some of the key themes we highlighted earlier this year, unpack what's changed, and more importantly, what it all means for the global outlook and for South Africa. To help us unpack these shifts and impacts is Sanisha Prakisamy, Group Economist at Momentum Group. Sanisha, thank you very much for joining us. I want us to start with geopolitics, which has been front of mind for markets. We've seen events like the short-lived operation in Venezuela from the United States, and we also saw the US-Israel attack on Iran. And both these events actually had different implications for the global outlook. The latter, in particular, has put much pressure on energy markets for fertilizers and commodities like aluminium. Can you unpack the main transmission channels? How do disruptions in one region filter through to global prices and supply chains more broadly?
Thank you, Tiamo. It's lovely to be here. Well, the Iranian conflict happened in phases. And so the first domino to drop was essentially the oil price and the price of natural gas. And that's because a fifth of those commodities transit through the Strait of Hormuz. The second domino to then fall over was essentially the risk aspect. And so we saw that, for example, container shipping costs went up by about 20%. And if we look at insurance costs, maritime insurance at its peak, in some cases went up 9-fold. And then the third domino to drop was really your upstream and your downstream industries. So as you make mention of fertilizer prices going up, and that's because of the components transiting through the Strait of Hormuz, agriculture becomes a weak point in the economic trajectory. With agriculture, also very reliant on logistics costs. Over in manufacturing, items as far-flung as things like plastics and paint have also seen prices going up. And so we've seen a number of auto manufacturers also complaining about rising input costs, and this can trickle over into consumer-related goods. Now, I do think that in the longer term, we are likely to see an overhang in the economic shadow coming through from the Iranian conflict, given that quite a big chunk of supply came out of the market. In particular, I do think we're going to see a reconfiguration of global supply chains coming through. And the second is quite concerning because we were of the opinion that the Middle East would come about with one singular approach. Now we are likely to see more geo-economic fragmentation even in that area. And one of the clues here was essentially the United Arab Emirates stepping out of OPEC.
You mentioned the potential long-term economic shadows of the war, and I think that's interesting because coming into 2026, the expectation was that the global economy will actually continue to be resilient, and the general environment was quite supportive of that. So we had recession risks that were low, inflation was easing, financial conditions were stable until geopolitical tensions started to rise. So how have these geopolitical developments actually shaped our economic growth outlook?
Well, generally, it's going to make it a lot weaker. And so we look to the International Monetary Fund's latest World Economic Outlook update that they produced in April. And they ran a number of scenarios. Now, quite testament to the high level of volatility, they didn't call it the baseline scenario, but rather the reference forecast, in which energy prices are about 20% higher. And it's in that kind of environment that we get global growth averaging just over 3% for 2026. Now, that's broadly speaking just slightly lower than what we've seen on the longer term average. They also run an adverse scenario in which we get a slight energy dislocation in markets. And so that has a pricing impact and a supply impact that comes through. And it's in that kind of environment that global growth averages around 2.5% for 2026. And then they run a more severe scenario. And it's really in that scenario where that energy dislocation in pricing and supply persists for much longer, even going into 2027. And the growth outcome here on average for the global economy for this year sits at about 2% and remains quite low going into 2027. And so that tells us that there would be some economies that are really teetering on the brink of a recession in that kind of world. Now, there are some economic winners and losers from the war. The big ultimate loser is going to be your Gulf nations. Yes, they do get the pricing impact coming through, but they also get knocked on the volume impact. Tourism flows decline, infrastructure is degraded, and risk sentiment toward that region remains quite negative. Other economic losers in this kind of environment, Europe and Asia. In Asia, we've got nations like India that are a net importer of oil from that region, and so they get heavily impacted. And if we look over to Europe, it's really your very industrialized nations such as Germany that still rely a lot on oil-related products. If we think about the United Kingdom, they came out of quite a soft growth period in 2025, and a lot of that soft overhang is going to persist into 2026. And according to the IMF, out of all the G7 economies, they had the biggest downgrade applied. Very little fiscal headroom to maneuver there as well, and 80% of households are still reliant on gas for heating purposes. And then we get some economic winners. And these are predominantly the countries that can export oil-related products that are a bit further away from the epicenter of the conflict. So I'm thinking about Canada, Norway, parts of Latin America. Russia is expected to see an increase in their government revenues of about $100 billion this year, and that's because sanctions were lowered. And if we look at the US, even though the consumer is negatively impacted and the fiscal dynamics because of more defense spending, the US has now become the #1 exporter of hydrocarbons. So quite a fragmented, diversified view in terms of where growth is headed.
So what I'm hearing is that the duration of the conflict, plus the country's dependence on energy, is going to be key elements for the growth outlook of these countries. Let's now move to inflation. So how have geopolitical developments changed the inflation outlook from what we were expecting at the start of the year?
Well, at the start of the year, it was looking as though disinflation was entrenched. So still positive inflation, but falling inflation over that period. However, we've now had this big exogenous factor coming in, which is the oil price. So again, turning to the International Monetary Fund's analysis and the scenarios that they've run, in that reference scenario, global inflation is expected to be at about 4%. Now, this is taking into account that you don't really have a lot of spillover effect. In the more adverse scenario, those underlying inflation risks start to pick up, so core inflation becomes more of an issue, and the global average for inflation here is about 5.4%. Okay. And then in the more severe scenario, this is really when wages start to pick up. price-setting behavior reacts to the Iranian conflict, and so you get more entrenched second-round inflationary impacts. The average headline inflation for the global economy above 6% for this year and remaining high into 2027. So ultimately, it will depend a lot on whether the country is a net oil importer, whether they're running a current account deficit, how has the currency fared in this environment, and whether or not inflation expectations have become de-anchored during the Iranian conflict. Ultimately, it also depends a lot on how quickly lost production can come back into the system. So according to Goldman Sachs, it would take about 70% of that production can come back on stream within a period of 3 months if the Strait of Hormuz is fully open. But there is a bit of a tail-end distribution there, so it will take 6 months for us to get to 88%.
Sure.
So what that does tell us is that there is some infrastructure that has been permanently damaged, but not necessarily affecting the bulk of that oil supply.
Okay. The heightened inflation concerns have also contributed to tighter financial conditions, which in turn have revived worries around an AI-related bubble, particularly given the debt dependence of many smaller non-listed AI firms. How are major central banks responding to these concerns?
Well, I think, at the start of the year, global central banks were quite comfortable about the pace of disinflation, almost allowing them to cut interest rates further. However, this has been turned on its head now with renewed inflationary pressures, and central banks are taking a far more wait-and-see, cautious approach and being very data-dependent. So when we look at the US Federal Reserve, markets were anticipating that they could potentially cut by 2 or 3 times this year. However, they're now expecting a slight hike by the end of the year as conditions have now turned unfavorably. The Federal Reserves themselves have warned about risks to their dual mandate and have upgraded some of their inflation forecasts. A crossover in the Eurozone, we've seen that the European Central Bank are now warning about risks of stagflation, which is lower growth outcomes and higher inflationary outcomes. Now, at the start of the year, the market thought that the ECB didn't really have to do much on interest rate policy, given that inflationary pressures were at bay. Now, with renewed inflationary pressures, the market's actually pricing in 3 interest rate hikes. But again, with the ECB signaling stagflationary risks, we do also worry about the growth impact, and we think that 3 interest rate hikes is a bit aggressive. And in a very similar vein, if you had to look at the United Kingdom, with the Bank of England, they were already struggling with very high elevated services inflation even before the Iranian conflict took place. And so while the market was anticipating between 1 and 2 interest rate cuts at the start of the year, the market is now looking to 2 interest rate hikes by the end of the year. But given that they have to start pulling in on the fiscal side, further monetary policy tightening could be very negative for the growth outcome. And again, here we see 2 interest rate hikes as being a bit aggressive.
So it seems like the market expectations can be a bit excessive, but generally the theme of higher interest rates for longer seems to be back. Then moving on to the fiscal side, the IMF has warned that these rising geopolitical tensions are adding fiscal pressures globally, which is forcing governments to make tougher trade-offs between security, debt sustainability, and essential public spending. How significant are these fiscal risks?
So with the geopolitical fragmentation, we have seen a reorientation of fiscal priorities. And this is why we've seen governments stepping up on the defense spending as a share of GDP. And then with the latest Iranian conflict, this is added to fiscal demands. And what we've seen coming out from governments this time around was a higher level of pass-through to consumers and businesses relative to the 2022 oil-related crisis that resulted from Russia invading Ukraine. And I think this is because governments are sitting on a much higher debt pile and have far less wiggle room on the fiscal side. Now, if we look at a report from Allianz, they've actually determined that emerging markets have spent up to 0.2% of GDP on fuel-related direct subsidies, and the similar number for developed markets is sitting at 0.15%. Of course, it does depend on the economy itself. Some are spending a bit more, especially if they are net oil importers. Now, to try and offset and address the issue of supply, we also have some demand measures that have been instituted, and half of the emerging market composite have done things like rationing fuel, trying to use strategic reserves, and even things like number plate rotation in a number of countries.
Okay. Let's shift to US politics and trade policy. Even before the recent geopolitical tensions and the negative impact that it had on gasoline prices, we were seeing signs that tariff-related inflation concerns were weighing on President Donald Trump's popularity. More recently, we saw major court rulings regarding these tariffs, and the first of which was the Supreme Court, which was striking down reciprocal tariffs which were implemented under the International Emergency Economic Powers Act. And then more recently, the Court of International Trade ruled that Section 122 tariffs, which were actually introduced as a replacement to reciprocal tariffs, were also unlawful. How significant are these court rulings for the direction of US policy, but also more broadly, to what extent could trade policy and its potential inflationary impact shape the political landscape as the United States heads towards the midterm elections in November?
Well, Tiamo, I think there's a lesson to be learned here that trade policy can't be unilaterally changed without any kind of legal implication. That said, there are still a number of options that the US administration can take, and so I don't think that protectionist policies are dead. And as you mentioned, although consumers didn't believe it at first, there is a bit of an inflationary impact coming through on the tariff side of things. With the Iranian conflict, we've seen that Trump's popularity has fallen even further. Now, typically, you tend to get a bit of a rally around the flag impact that happens around the popularity of the presiding president. But we also know that this was a war of choice, and most American citizens were not actually in favor of the Iranian conflict. And the longer that the conflict dragged on, we saw that Trump's popularity fell even further.
Yeah.
So going into the midterm elections, it's going to be quite interesting to see whether that Republican support fractures even more. And I think it's going to be quite difficult for the Republicans to hold both houses of Congress.
But we know that geopolitical tensions didn't just shift growth and inflation expectations, but also how markets are pricing key assets. We saw shifts in the United States dollar, movement in gold prices, but also a broader increase in perceived financial market risk. How should we think about these market reactions? But importantly, how should we distinguish between short-term movements and the longer-term structural view?
Well, markets reacted in a typical risk-off lens, as they should. The only atypical response really came through from the asset class being gold. So typically you would expect gold to rally on the back of it being an inflation hedge, but we actually saw gold dipping initially in the conflict. This doesn't, however, derail our thinking around the medium-term story, where we do still see a structural underpinning for gold as emerging market central banks continue to diversify away from US-based assets as they continue to need an inflation hedge and a hedge against geopolitical risks that are still firmly embedded in the global economy. Where we did see a very typical response was on the US currency, the dollar, which strengthened given that it is a liquidity anchor, and we saw government bond yields also selling off. Now again, with the US dollar, we have the short-term strength, but again, not derailing our medium-term thesis that we will continue to see US dollar weakness over time as investors become very concerned about the fiscal deficit and high debt levels in the US and the credibility issues of the US institutions.
So the longer-term structural view remains intact. Turning to South Africa, the global developments have risen concerns around fuel prices and inflation risks. And we also saw the SARB's tone shift to being more hawkish. Can you unpack the inflation risks that are driving this change in stance from the SARB?
So very similar to what we're seeing in the global landscape, inflation was continuing to get low in South Africa over the course of last year and into the beginning of this year. However, we have now had this exogenous impact of the oil price kicking in. And so central banks in South Africa as well now has to take a look at how second round inflationary impacts can evolve from here. Now, the direct impact is, of course, through the oil price. And fortunately for South Africa, where we get our crude oil has shifted in the last while. So we get quite a big chunk from places like Angola or Nigeria. And so that does reduce the direct risk. However, our refining capacity in South Africa has either been mothballed, there are some delays in bringing refinery capacity back online. And so with that in order, we're actually getting in a lot of refined product from other countries, predominantly from the East. However, a lot of what comes in from the East, the underlying product is still coming through from the Strait of Hormuz. So we can't really get away from the problems in that area. Now, when we look at transportation costs, it really differs across the income earning spectrum. So when we look at the top 20% of spenders in South Africa, about 9% of their wallet share goes towards running costs for their vehicle. So that would be fuel related or maintenance related. For the rest of the basket, between 4.5% and 6% of wallet share goes towards public transport costs, which we know are very sticky on the way down. Now, I think the real problem is if we have that coming into the agricultural space and food prices start to pick up on the back of logistic costs being a lot higher. Because in South Africa, the lowest 30% of spenders, about 30% of their wallet share is going towards food costs. And so here, the central bank in South Africa has to be very attuned to how inflationary pressures go into wage price pressures and price setting behavior. And in order for them to maintain credibility of protecting that 3% inflation target, they may actually have to consider raising interest rates.
So monetary policy could respond to this by higher interest rates. But we do know that the government has stepped in and they reduced the general fuel levy by 3 Rand to try and cushion consumers and businesses from this shock. Now, with that in mind, how would you assess South Africa's fiscal position? And do you think South African government still has room to be able to absorb some more external shocks?
Well, let's give credit where it's due. And so, I think National Treasury has done quite a good job of trying to secure a primary budget surplus in the last while. However, debt is still high, so we're not in a completely comfortable fiscal position. And in order for us to secure a higher credit rating over time, we do need to support that fiscal anchor together with continued structural reforms in order to secure that economic anchor. Now, if we look at what government is planning to spend on fuel-related subsidies up until the end of June, it comes to about 17.2 billion, which I think National Treasury can stomach, given that we have had an overrun in some of the revenue streams.
Okay.
However, in the longer term, we need to become more insulated against global shocks that can affect exogenous factors like the oil price or even food prices. So in this instance, it means reforms in the economy, such as ensuring that public transport is available to the majority of our citizens and is safe and reliable, to ensure that more freight can actually move away from road onto rail, and maybe even thinking about things about restructuring the road accident fund and its levy as an example.
Okay, lastly, let's turn to South Africa and our economic growth. We do know that the prospects of South Africa's economic growth have actually weakened since the start of the year. And we are starting to now see a rise in political uncertainty, and this could further weigh on economic growth prospects. The local government elections, set for 4 November, are adding some uncertainty against the backdrop of ongoing pressures around governance, service delivery, constrained fiscal space, and infrastructure challenges such as water provision. Furthermore, the recent Constitutional Court ruling regarding Phala has actually reopened the path for a public impeachment process against President Cyril Ramaphosa. This rising political uncertainty could actually deter much needed fixed investment, which is quite important for South Africa's growth on a longer term basis. But we do know that much of the pressure comes from the global side. So can you unpack how these developments are actually shaping South Africa's economic growth outlook?
So I think there's 2 main channels that South Africa gets impacted by. The first is the financial mechanism. And so when we have tighter financial conditions globally, those tend to infiltrate into our local environment. And the second angle is the real economy. So when oil prices shot up, we had a negative impact on our terms of trade, as an example. And also the demand for our exports goes down because global demand is expected to be a lot softer. But even locally, we were banking on quite a big recovery coming through on real wage gains for consumers. But a lot of that purchasing power gets wiped out by higher oil prices. And similarly, on the investment side, as you point out, businesses tend to defer projects when there's a high level of instability politically domestically, but also in terms of the global economic landscape. But not to get too negative, because I do think that the recovery is merely just delayed rather than derailed. We are still very optimistic about some of the structural reforms that are happening in the areas of energy and logistics in particular.
Sanisha, that was a very interesting discussion. In conclusion, Geopolitical developments are increasingly shaping not just commodity markets, but also growth dynamics, inflation trajectories, and central banks' reaction across major economies. Importantly, the transmission is not uniform, with different regions expected to experience different outcomes depending on energy dependence and fiscal space. For South Africa, these global forces matter a lot through higher price pressures, tighter financial conditions, and weaker global demand, all of which weigh on growth and inflation alongside local structural constraints. A key theme that comes through, though, is that while these shocks may disrupt the near-term outlook, the longer-term recovery remains intact. So it's more about delay than derailment. Thank you for your insights, Sinisha.
Thank you so much, Tiamo.
Thank you for being with us today. Until next time.
Thank you, Sanisha and Tiamo. Next, we have Rupert Tressing, one of our portfolio managers at Equilibrium Investment Management, who will provide context and update to the global and local markets. Over to you, Rupert.
Thank you, Matula. Good day. How quickly things can change. We went from the fourth quarter of 2025, where we saw all major asset classes producing a positive annual return for the first time since the pandemic, to a roller coaster of a ride during the first quarter of 2026. As the year began, investors wrestled with the implications of the artificial intelligence or AI boom. But unlike years past, when the AI boom helped drive the bull market in tech stocks, the focus in the first quarter was on concerns over high AI-related capital expenditures, as well as the companies that could be hurt by AI, the so-called software as a service model. Then came the last week of February, when the onset of the Iran war and closure of the Strait of Hormuz led to surging oil prices and injected an entirely new level of uncertainty into global financial markets. The net result? Falling stock markets and rising bond yields, completely derailing the upward trajectory of markets during January and February. Global bonds, as measured by the World Government Bond Index, and global equity, as measured by the All Countries World Index, were down 1.1% and 3.2% for the quarter in US dollar terms, respectively. For bonds, it was a tug of war between rising inflation and slowing growth, as yields rose across the market as the oil price spike renewed inflation concerns. Global property started the year with slow but steady performance, with a total return of 1% in US dollar terms for the quarter. Data centers were a top performer, benefiting from structural demand tied to AI and cloud adoption, while office sectors continued to face some challenges. Global equities, bonds and property have all still delivered positive returns of 20%, 3.7% and 6.9% respectively over the past 12 months, despite the sell-off in March, while global cash returned a respectable 4.1%. From a regional perspective, US equities were down 4.6% in US dollar terms in the first quarter. The primary driver was a dramatic repricing of US Federal Reserve interest rate expectations, which went from multiple rate cuts at the beginning of the year to zero by the end of the quarter, as the significant surge in oil prices reignited inflation fears. According to a report by the US Energy Information Administration, the price increase during the quarter was the largest on an inflation-adjusted basis in data going back to 1988. But, as mentioned earlier, other drivers and themes also contributed, as investors began questioning the return on investment of massive AI infrastructure spending, as well as the companies that could be hurt by AI, the so-called software as a service model. These new technologies lower the barriers to entry, disrupting long dominant business models where traditional per-seat licensing models are pressured by autonomous AI agents to replace manual workflows, allowing for rapid, custom app creation. Traditional companies are forced to adapt to AI native competition or risk shrinking margins and relevance. For years, companies bought software because building it themselves was too slow and expensive. Generative AI is flipping that equation. Tools like Anthropic's Claude, OpenAI-powered coding assistants, and other similar products allow non-engineers to create custom tools with relatively simple English language prompts. The shift means that the very foundation upon which software as a service companies have built their business models over decades is threatened. For investors, this means a strategic rethink. The future cash flows, which form the bedrock of company valuations, are now clouded with uncertainty. Elsewhere, trade policy uncertainty also persisted after the US Supreme Court ruled against the use of reciprocal tariffs announced in 2025, with the US administration implementing a flat 10% tariff on all imports in response. Japan and the UK were outperformers in the developed market space, up 1.4% and 2% in US dollar terms respectively for the quarter, and now also being the best performing developed markets over the past 12 months. In Japan, the Liberal Democratic Party's victory in the February snap election combined with continued yen weakness bolstered export-oriented sectors. In the UK, a similar picture played out, with gains being supported by the relatively large weighting of the energy sector along with a weaker sterling which helped export-oriented larger companies. The MSCI Europe ex-UK index was down 4.2% in US dollar terms, as the surging gas prices and proximity to the geopolitical tensions weighed on sentiment. Overall, global developed market equities as measured by the MSCI World Index were down 3.6% in US dollar terms, but still up 18.9% over the past year. Emerging markets outperformed its developed market counterparts again, finishing the quarter nearly flat, down 0.2% in US dollar terms, but still up 29.6% over the past year. It was a tale of two differing market themes over the quarter, with Taiwan and South Korea leading strong EM outperformance in January and February, supported by a weaker US dollar and ongoing strength in AI-related technologies. However, the Middle Eastern conflict led to a sharp reversal in March as high energy costs, supply chain disruptions, and uncertainty weighed heavily on global risk sentiment, particularly for energy importing EM countries, notably Korea, Taiwan and India, that remained a notable drag. The Latin American markets of Colombia, Peru and Brazil were top performers and offset some of the losses in the quarter. The region benefiting from high commodity prices and being a net exporter of oil, Brazil saw a significant jump, up 19.1% in US dollar terms. Overall, South Korea outperformed, posting double-digit returns of 16.5% in US dollar terms, driven by ongoing strength in the technology sector. Strong gains, supported by ongoing strength in AI, were also made by Taiwan, despite the correction in March due to the market's energy price sensitivity, especially in energy-intensive semiconductor and technology stocks. China underperformed as AI-related advancements pressured internet stocks, although the country was better positioned to absorb spillover from the Middle Eastern conflict, given its large oil reserves and diversified energy mixture. India was one of the largest underperformers, down 18.1% for the quarter, with growth concerns, reliance on oil imports, and expensive valuations weighing on the market. Sector returns are amongst the visible signs of investors rotating out of the former market winners into stocks that have been lagging. Since mid-2023, the big winners in the market have been in the technology and communication services sector, thanks to the tailwinds of the AI boom. Recalling our Q4 2025 market overview at the end of 2025, communication services stocks, which include Alphabet, were up 3.3% for the quarter and 32.6% for the year, while technology stocks were up 2.9% for the quarter. Meanwhile, basic materials gained 6.5%, while energy stocks rose 2.6% for the quarter and 13.7% for the year. The first quarter of 2026 looked very different. Energy stocks led the market with a 33.6% gain for the quarter on the back of the oil price leap. But beyond that move was a broader rotation into other previously lagging sectors. Utilities ranked second, up 8.4%, whose defensive nature helped them build on gains posted during the AI stock boom, thanks to surging power needs for data centers that we covered in detail at our previous quarterly feedback session. Behind them was basic materials gaining 6.6%. Meanwhile, technology stocks were led lower, down 6.7% by declines at Microsoft and Nvidia, and a drop of over 6% for Apple. Communication services stocks, which lost 7.8%, had their biggest first quarter decline since the third quarter of 2022, with Facebook, Instagram and WhatsApp owner Meta platforms dropping 13.3%. Consumer discretionary was the worst performing sector, down 10.9% for the quarter. It is worth noting that except for consumer-driven sectors, all others have still returned above 20% over a 12-month period, despite the volatility that the market experienced during the first quarter. This is perhaps an indication of how hard markets have run prior to the start of the Iran war, as investors started taking ongoing double-digit returns for granted. For years, value stocks have been left in the dust by gains in growth stocks. The last time value bested growth for a full calendar year was during the 2022 bull market. Now, for the second consecutive quarter, value stocks have outpaced growth, quickly catching up on an annual basis as well. The outperformance was again led by big gains in the previously mentioned energy sector, with stocks such as ExxonMobil and Chevron up in the region of 40%. With energy and value valuations much more favorable relative to growth and tech stocks after several years of underperformance, it has allowed the rally to move faster and run further. Another first quarter trend was the buoyancy of small and mid-cap stocks compared to large caps. This too reflected a change in the landscape. The tech names that have suffered are in the large cap segment, which have pulled large caps down relative to small caps. Small caps have, of course, also lagged from a valuations perspective, so the rotation also had them poised for outperformance. After reaching all-time highs early in the quarter, the local equity market as measured by the FTSE JSE Capped All Share Index was not immune to the impact of the Middle Eastern conflict and broader EM sell-off. The index suffered one of its worst monthly drawdowns during March, falling 10.5%, trimming back early year gains and ending the quarter down by 0.6%. However, following on the back of very strong returns in 2025, primarily driven by the resources sector, the index is still up a significant 54.1% over the last 12 months. SA nominal bonds, as measured by the FTSE JSE All Bond Index, also experienced a major repricing in March, down by 6.8% for the month and 2.7% for the quarter, once again driven by concerns around rising inflation and a shift in market expectations away from the previously predicted interest rate cuts because of higher oil prices. The 10-year bond yield began the year strong, falling to around 8% in January. However, the March madness saw yields climbing abruptly, ending the quarter in the region of 9%. The largest detractors were bonds in the 7 to 12 years and the 12 years plus maturity buckets, which were down 3.8 and 4.1% respectively. Listed property did not escape either, given its sensitivity to bond yields and interest rate expectations, and ended the quarter down 5.1%, but still up 29.1% over the past year. Cash, as measured by the STEFI composite, delivered a steady return of 1.6% for the quarter and an annual return of 7%. Given the impact of the Middle Eastern conflict on oil prices and potential inflation, the market pivoted sharply from pricing in further rate cuts at the beginning of the year to the possibility of rate hikes, improving the outlook for the asset class. From an equity sector perspective, resources saw significant volatility during the quarter. Initially, it was a top performer, with companies like Sibanye-Stillwater and Glencore rallying in January. However, the March sell-off hit miners hard, resulting in the sector declining steeply, down 15.2% during March, but still up 7% for the quarter. The financial sector was also heavily affected, wiping out all early gains to end the quarter marginally down by 0.4%. Industrials were down 9.1% under the broader risk-off sentiment. Large cap industrial shares were amongst the biggest losers on the JSE. Notably, Naspers and Prosus were down by over 20%, while Richmond was also severely impacted by high exposure to global geopolitical risks and luxury spending concerns. The rand started the year with a strong rally, benefiting from positive sentiment and strong commodity prices. But since the start of the war in Iran, the US dollar was boosted from its status as a safe haven and expectations that surging oil prices would lead to higher inflation, which in turn would limit Fed interest rate cuts. As a result, the rand weakened by 3.3% against the US dollar at the end of the quarter. This helped to offset some of the negative and depressed returns from global asset classes in rand terms, with global cash and property being the top performing asset classes in rand terms for the quarter. This serves as a reminder of the benefits of portfolio diversification, with exposure to all asset classes, which together with a staying invested approach remains the best way of navigating periods of increased market volatility. Over a 12-month period, the rand is still up almost 7% against the US dollar, which detracted from global returns, but here we still see very strong returns from global asset classes coming through, with the exception of global cash, bonds and property, that were the only asset classes to not outperform inflation over a one-year period. The exact same asset classes that outperformed during Q1 of 2026. Ultimately, Q1 of 2026 once again demonstrated the critical role that well-diversified portfolios play in sustaining long-term investment success. There was clearly no shortage of economic and geopolitical events in the first quarter of 2026, and there is still a high degree of uncertainty around the interim impact on markets. But further to highlighting the importance of diversification in successful portfolio construction is also a good time to remind ourselves of the potential severe impact on investment returns of making quick, sentiment-driven decisions in reaction to short-term market volatility. Markets are constantly searching for clarity, and when volatility increases, clarity reduces dramatically. When markets then start to recover again, they usually do so very quickly, the same as when they start to fall, as these impacts lead to significant short-term shocks and asset mispricings with lower valuations. As soon as there is a resolution to a crisis period, clarity returns to the markets, navigating the way forward. Markets typically react swiftly and valuations return to where they were before the crisis started. The best way to navigate this uncertainty is to stay invested, as it's extremely difficult to try and time the market to capture the turning point. Taking a closer look at the timeline of South African equity returns over the past 60 years, we can see that the current war in Iran is but one of many crisis periods and temporary shocks that the market has endured over the decades. Starting with the end of the Bretton Woods system in 1971, US President Richard Nixon suspended the convertibility of the dollar into gold, moving the world to a floating exchange rate system, leading to the market going down by 58% over a 50-month period. Then followed the first oil crisis in 1973, where the Organization of Arab Petroleum Exporting Countries, or OPEC, oil embargo quadrupled oil prices from $3 to $12 per barrel, triggering stagflation, which is a combination of high inflation and high unemployment in Western nations. These were followed by multiple similar scenarios through the decades: the Asian financial crisis in 1997 to 1998, the dot-com bubble burst in 2000 to 2002, then a major event in the global financial crisis in 2008 following the collapse of Lehman Brothers. It was the worst recession since the 1930s, caused by the US subprime mortgage market crash. Then, of course, still quite fresh in our minds, the COVID pandemic in 2020, which saw unprecedented global lockdowns that caused the deepest contraction of global economic activity since World War II, which then led to the global inflation spike and supply chain disruptions with rapid interest rate hikes from central banks worldwide during 2022 and 2023. Then, of course, two exceptional years for markets in 2024 and 2025, in spite of the Russia-Ukraine conflict and fragmented trade, and the IMF reporting a slowdown in global growth. Where would investors be if they panicked every time that there was a crisis in financial markets? While there is no exact answer to the question, these events always create wonderful opportunities to illustrate the devastating impact on returns of short-term decision-making and overreaction. Consider the following: R1 million invested in the South African equity market at the start of the global financial crisis in 2008 would have been worth roughly 550,000 rand at the lowest point in October 2008, a mere 5 months later. But staying invested meant that it would have grown to 5.9 million rand at the end of March 2026. Similarly, R1 million invested in January 2020, just before the start of the COVID pandemic, would have fallen to 647,000 Rand at the lowest point on 17 March 2020, but subsequently would have grown to 2.3 million Rand at the end of March 2026. In both cases, we can see that as significant as the correction in the market was at the time, it is now but a blip on the radar. To better understand the impact of these significant market movements on investment growth, let's take a closer look at an example of what would have happened if an investor switched out of the market at the bottom and missed some of the most important recovery days. The long-term average return of the South African equity market from January 1995 to March 2026 is 13.9% per annum, as indicated by the green bar. If an investor missed only the top 5 days, the impact would have been a reduction of 1.3% per year, as shown on the first red bar. Following on that, the impact of missing the top 10 days would be 2.3% per year, the top 15 days 3.2% per year, the top 20 days 4.1% per year, and the top 50 days a massive 8.2% per year. We can see that it's substantial, but looking at it in terms of percentages does not give us the full picture. What does it mean in Rand terms? This is where it starts to sink in. Staying invested would have seen the 1 million Rand growing to 57.5 million Rand. Missing the top 5 days means that 1 million Rand invested will be worth 40.9 million Rand. Fast forward to missing the top 50 days means that your 1 million Rand would be worth only 5.6 million Rand, or 1/10 of the value had you stayed invested. To put things in perspective, 50 days is 0.44% of the number of days invested over 31 years, but the impact is an investment that is worth roughly 90% less. The key takeaway here is that the best and worst days often happen very close together. Volatility doesn't mean that only days with negative returns increase. A significant number of the most volatile days are also gains, and it's these days we don't want to miss out on. Looking at it from a different angle, if we take the same period from 1995 to 2026 as in the previous slide, we see that the average daily return is 0.06% per day. However, the daily return post the bottom of a crisis period for the first 5 days is 2.03%, or otherwise stated, 33.8 times the average long-term daily return. For the first 10 days, it's 1.17%. For the first 20 days, it's 0.79%. And for the first 50 days, it's 0.42%. A clear picture presents itself. Market crisis times, when volatility is at its highest, is the most important time to stay invested. The old saying holds true. It's all about time in the market and not timing the market. I'll leave you with the following quote by legendary investor Sir John Templeton. The 4 most dangerous words in investing are, "It is different this time." As responsible investors, the best thing to do is to stay disciplined and to learn from past market trends and history. Don't speculate that this particular time will be any different. Thank you.
Thank you, Rupert. Next is Nosibusiso Ngondui, one of our portfolio managers at Equilibrium Investment Management, who will provide us feedback on the South African model portfolios.
Hello everyone. Many thanks Rupert for setting the scene. In this section, I aim to focus on 3 things. Looking at how the portfolios performed against the backdrop that Rupert painted, what actually drove these returns, and lastly, how we are positioning the portfolios going forward. At the end, you should hopefully have a clear view of performance, what's behind it, and what it means for your clients. Let's begin by looking at portfolio performance. This table here shows the performance of the local portfolio range as of March 2026, arranged from conservative to aggressive. The red blocks highlight the recommended investment period for each portfolio. Coming into the year, portfolio returns were on track to continue to deliver strong returns as seen last year, until the US and Iran conflict broke out and reversed the gains. SA asset classes were the hardest hit as a risk aversion took hold. As a result, all the portfolios, save for the income portfolio, posted negative returns during the quarter. The conservative portfolio was down around 1.5%, while moderate and growth portfolios fell roughly between 2% and 2.6%. While the negative returns are disappointing, this is not surprising in an environment where local growth asset classes delivered double-digit negative returns in March. Importantly, we see this as a short-term pullback, and pleasingly, we've already seen a rebound in market returns through April. Now, compared to peers, the portfolios lagged slightly this quarter, owing to a combination of manager selection and TAA or tactical asset allocation calls. Coming into the year, we maintained an overweight exposure to local asset classes, a view that worked in our favor last year but reversed in March. But despite this, we continue to see compelling value in South African assets compared to global peers. We believe that while geopolitics can create short-term uncertainty, they rarely derail medium-term investment outcomes. Now, if you zoom out to 1 year period, the picture is much stronger. Returns range roughly between 14% to over 16%, well ahead of inflation plus benchmarks and broadly in line with or slightly ahead of peers. More importantly, when aligned to investment horizons, returns remain consistent and ahead of target. This is again testament to the power of our outcome-based approach to portfolio construction. So if there's one message here, it's that short-term volatility has not derailed long-term outcomes. Let's now unpack some of the key drivers to returns over the 1 year period to March. At a high level, asset allocation did most of the heavy lifting, benefiting from strong returns from the local market in particular. Tactical positioning added incremental value, while the biggest pain point came through manager selection, which we'll pick just now. Overall, portfolio returns remained strong and resilient relative to the benchmark and to peers. Now, looking more closely at tactical positioning, the call that added the most value over the last year was our decision to be overweight SA equity. This was funded by underweight exposure to cash. These TAA contributions, as you can see, were modest but consistent. And that's exactly how we position TAA. It's a lever we use to enhance outcomes, not dominate them. Turning to manager selection, the past year has been a challenging environment, more so for SA equity managers, as market returns continue to be largely concentrated in the resources sector. This made it difficult for active managers to outperform, particularly those who pay no attention to the benchmark in the way they construct portfolios. Both Elliott and Ford, in our case, had material underweight exposure to resources, particularly gold miners, and that's been a notable drag to performance. We have since made some adjustments, as discussed last quarter, to shift the SA equity execution towards managers who still take active views, but are a bit more aware of the benchmark. This is really about reducing unintended risks while still maintaining flexibility. And encouragingly, we are already starting to see signs of improvement. The Visio Unconstrained Fixed Interest Fund in our SA bond execution was another big detractor to portfolio performance. The fund struggled to keep pace with the OB benchmark because of its conservative nature, especially from a duration perspective. So to reduce benchmark risk, we began transitioning the SA bond execution in Q1, and I will unpack a bit more of this later. That said, not all was bad. We also had some positive manager selection alpha, particularly in the fixed income strategies. These were, however, not large enough to offset the weaker equity performance. Let me briefly touch on hedge funds, more so given the heightened levels of volatility that clients have had to navigate recently. In periods like this, diversification becomes all the more important, and hedge funds have proven to be a valuable source of return diversification. We launched 2 hedge fund solutions in August last year, which now have an 8-month track record up to March. The longer-term numbers are back-tested returns. The Equilibrium Stable Hedge Fund is conservative in nature and focuses on capital protection. The Growth Hedge Fund, by contrast, seeks to deliver equity-like returns with lower volatility. Overall, both solutions have behaved as intended to date. The Stable Hedge Fund protected capital during the recent market shock in March. Over the same month, the Growth Hedge recorded a drawdown consistent with its higher risk, but lower than the SA equity market. And that's really the role these solutions play in client portfolios. Provide return enhancement and diversification, as well as downside protection. Now, if we step back for a moment, what's the key message through all of this? It's simple. Don't panic. Yes, headlines may feel overwhelming, but that's typical market noise. The right response is discipline, which means avoid emotional reactions, stick to process, and stay focused on client outcomes, which is exactly what we do. This steady approach helps navigate turbulence without overreacting. And this is also key for your conversations with clients, especially during periods of uncertainty. Now, before moving to positioning, it's worth reminding ourselves briefly of the framework that underpins our investment decisions. The outcomes-based philosophy, which is a client-centric way of constructing portfolios. At its core, the goal we're working towards is shaped by 3 key things, which are the client's investment horizon, their risk appetite, and the market opportunity set. So rather than starting with short-term market predictions, like trying to guess what markets will do next week, we start by defining the time frame and the risk budget. Now, once those are set, we establish a range of reasonable expected outcomes. And importantly, we accept that this range can evolve as market conditions change. That's really what keeps our process disciplined and grounded. We focus on achieving outcomes within a defined probability range rather than trying to predict every twist and turn in markets. Now, this slide here is a reminder of what ultimately drives results. The dominant factor, as you can see, is asset allocation, which we've shown here as contributing about 70%. Strategy adds the next layer at 15%, followed by mandate at 8%, with the remaining 7% coming from other factors. The practical takeaway for us is that we stay focused on getting the big building blocks right, particularly in volatile markets. We dedicate most of our effort to the asset mix and to managing the key risk exposures that are most likely to drive return outcomes. Importantly, we are careful not to let short-term noise push us into making unnecessary changes. A familiar phrase we often hear in uncertain times is, "This time is different." And indeed, in periods of extreme volatility, the story can often feel unique, while the path forward can look uncertain. However, while every cycle feels unique, we believe and have learned through experience that history provides perspective. Our approach during such periods is to acknowledge that uncertainty, but not be paralyzed by it. Rather than trying to bet on a single specific path, we lean on the framework we've just covered and we draw on the evidence of how markets have typically behaved following periods of stress. The pattern is actually quite consistent. Now, on this slide, for example, we're looking at how oil prices have typically behaved following geopolitical shocks since 1980. History shows us that these moves tend to normalize relatively quickly, usually within 6 months. So while the initial reaction can be quite sharp, the historical pattern, as reflected in the median line, is that oil prices often normalize as the shock is absorbed by the market. The intention here is not to downplay the risks, but rather to provide context that markets tend to adjust faster than expected. Now, this slide tells a similar story for equities using the S&P 500 after geopolitical shocks since 1980. US equities have also tended to normalize within roughly 5 months. The chart's median line shows a familiar pattern. Markets often dip at first, then recover as uncertainty fades and investors refocus on fundamentals. The last two slides essentially reinforce the broader message we started with, that while shocks and volatility can feel unsettling, history shows that markets usually stabilize within months, not years. That's why we stick to a disciplined process, which helps us to manage risk thoughtfully and avoid emotional reactions. So what are we doing in portfolios? Honestly, not much has changed. Yes, we've seen bouts of short-term volatility driven by geopolitical events, but in our experience, these rarely derail medium-term investment outcomes. We continue to believe that the medium to long-term trends remain intact and should reasset once geopolitical stresses ease. In terms of positioning, we still favor emerging markets over developed markets. Elevated valuation risks in developed markets make them less appealing. Emerging markets, on the other hand, continue to offer attractive opportunities, even after the strong run they experienced prior to the Iran-related volatility. Closer to home, South African assets remain compelling. We continue to hold a moderate to large overweight in SA equities, alongside a small overweight in SA bonds. Both positions are funded from SA cash, where potential returns have declined. On the global side, our overweight exposure to emerging markets is funded from global bonds, reflecting our concern about rising inflation risks in that asset class. So in summary, while short-term noise is inevitable, our tactical positioning is designed to enhance long-term outcomes. We remain confident that these calls are well aligned with both the opportunity set and the risks we see in the current environment. On SA bonds, we've made some adjustments. We've shifted the remaining allocation from the Visio Unconstrained Fund into the Visio Bond Fund, an OB mandate managed by the same team. The change is motivated by the current interest rate and inflation environment, where traditional bond strategies with duration exposure have been rewarded, and to improve long-term consistency of outcomes for clients. While the unconstrained fund's low duration and defensive profile can add value in periods of stress, it has lagged in the current market environment, where nominal bonds have outperformed. Moving into a specialist bond fund improves alignment with our current market view. It reduces structural mismatches in how bond risk is expressed in our execution, and it enhances diversification. Importantly, this adjustment remains well within our risk framework and positions the bond allocation to capture opportunities while staying aligned with our benchmark. Now, this slide compares the current South African bond execution in red with the revised construct in blue, both being measured against the OB benchmark. The revised construct shows stronger consistency in tracking the benchmark with reduced periods of underperformance and a steadier alpha profile. And overall, we believe that the revised allocation is better positioned to deliver incremental outperformance while staying aligned with the benchmark, and thus offering clients a more reliable balance of risk and return. The quartile bars and table give a sense of return outcomes across different periods. Results show that the revised construct delivered consistent outperformance versus the benchmark and competitive returns relative to peers. In our view, this change improves risk alignment and strengthens consistency of delivery. We also made a change in our hedge fund allocation. We've taken the decision to terminate our investment in the Amplified Diversified Income Hedge Fund, which is managed by Acumen Acuity. We had ongoing qualitative concerns, particularly around poor communication and reduced accessibility to the team. Alongside this, we observed a corresponding decline in returns. This has been under review within the hedge funds team since last year, and we believe now is the appropriate time to act. We have identified the Agile Fixed Income Hedge Fund, which is managed by Apex Investments, which in our view offers a stronger strategic fit and enhances the overall quality of the portfolio. This is just a summary of the portfolio actions I discussed. So in closing, yes, short-term returns have softened, but performance remains strong over one-year periods and longer. The portfolios are aligned with their long-term objectives, and importantly, they remain well-positioned to outperform. So when speaking to your clients, the message is clear. Stay disciplined, focus on long-term outcomes, and trust the process. Thank you for your time.
Thank you, Nosibisiso. Next up is Kal Chetty, the Head of Investment Proposition at Equilibrium Investment Management, who will introduce Herman, the Head of Asset Allocation at Momentum Investments, who will talk about asset allocation in times of heightened uncertainty.
Thank you, Matula, and hi everyone. Risk and uncertainty are an inherent part of investing in financial markets. As professional investment managers, our job is not to eliminate risk and uncertainty, but to measure, manage, and utilize it to deliver on the investment outcomes our clients are trusting us to achieve. But periods of heightened uncertainty, like the one we find ourselves in now, can test the strategies of even the most disciplined and experienced investment managers. In today's discussion, I'll kick off by unpacking how we at Equilibrium think about and manage asset allocation in our client portfolios during both the good times and the bad. I'll then hand over to Herman van Pappendorp, Head of Asset Allocation at Momentum Investments, who will articulate where we're seeing both the risks and the opportunities from an asset allocation perspective against the backdrop of the ongoing war in the Middle East. Perhaps the first point to make is that episodes of heightened uncertainty, where the world truly feels like it's coming to an end, are actually par for the course when it comes to investing in financial markets. From the end of the Bretton Woods system in 1971 and the Arab oil crisis in 1973, to the dot-com bubble of 2000 and the great financial crisis of 2008, the history of financial markets is littered with episodes of extreme uncertainty. And during such times, the temptation to declare conditions unprecedented and to significantly de-risk portfolios increases dramatically. But history teaches us that each one of these so-called Armageddon events tends to be a small blip on the upward long-term trajectory of equity markets. So the real danger is not staying invested during times like this. The real danger is exiting the market, then trying to time when to get back in. And this is a strategy not even the most skillful and respected fund managers can get right consistently, and a strategy that can easily result in permanent capital loss for both the professional and the average investor. So how do we think about and approach the problem of asset allocation in our client portfolios? Well, it's a direct function of the outcomes we are aiming to deliver on for our clients. And as a reminder, we define those outcomes across 3 dimensions that best capture the intent of the investment. The first is the investment time horizon, or the duration of the investment. The second is the risk the client is willing to stomach on his investment journey. And here, it's important to define and communicate risk in a way that is most meaningful for clients, so that clients are not surprised when risk hits them on the downside. And our preferred measure of risk is a statistical metric known as value at risk, which simply measures the worst possible drawdown or capital loss a given portfolio can experience in any given year. And each one of our portfolios targets specific levels of value at risk, which can be communicated upfront to clients. And this is a powerful way of helping clients to stay invested when downside risk does hit, as they've already been prepared for that possibility. Then the third and final parameter of defining the outcome is the return the client should reasonably expect from the portfolio over the investment time horizon. And we express that return in real terms, as wealth is only truly grown when you achieve returns in excess of the inflation rate. Once we have defined the outcomes we need to solve for, the next question is, well, how do we go about solving for it? And as can be seen on the pyramid chart here, strategic asset allocation, or SAA, which is the decision to remain invested in an optimal static mix of asset classes, is by far the most important decision, as it alone contributes 70% towards the probability that a portfolio delivers on its outcomes. The second biggest decision is strategy selection, and this represents the optimal mix of value-adding strategies that can be accessed within each asset class. So for equities, for example, it would represent strategies like value, quality, growth, and momentum. And for fixed income, it would represent strategies such as duration, credit, and yield curve positioning. And the mix of strategies selected within each asset class contributes 15% towards the probability that a portfolio delivers on its objectives. Next is manager selection, which represents the impact of security selection within each of the strategies that were highlighted in the previous step. This contributes just 8%, but ironically and unfortunately is where most clients spend the bulk of their time. Then lastly, the other component captures things like hedging and tactical asset allocation, or TAA. TAA represents the decision to deviate away from the SAA in the short term in order to either enhance returns or mitigate risk. For example, taking a decision to aggressively move a portfolio away from equities and into cash because of the Iran war would represent a TAA decision. Now, the trouble with TAA is that you need to get it right on both sides of the market movement in order for the decision to add value. Not only do you need to correctly time when to exit the market, you also need to correctly time when to get back into the market, a decision that not even the most skilled and experienced fund managers can get right consistently. This is because markets move quickly and in advance of the actual events. And if you get back into the market too late, you would have actually been better off just staying invested in the SAA. So, to limit the negative impact of bad timing decisions, we acknowledge our lack of a crystal ball by typically restricting our TAA calls to a maximum of 5% away from the portfolio's SAA. Taking larger TAA bets can seriously undermine the portfolio's SAA and therefore its ability to deliver on its targeted investment outcomes. The table here breaks down the investment outcomes of 3 of our flagship model portfolio solutions. The Equilibrium Conservative Portfolio has a 3-year investment horizon. Its value at risk target is -2%, which means there's only a 5% chance that the portfolio can lose more than 2% over any given 1-year period. If we stick to the portfolio's strategic asset allocation, it has a 70% probability of delivering CPI plus 3.7% over any given 3-year period, a 60% probability of delivering CPI plus 4.7% over any given 3-year period, and a 50% probability of delivering CPI plus 5.7% over any given 3-year period. The portfolio is designed for investors who have a shorter term horizon and don't have the willingness or ability to stomach large short-term drawdowns. In contrast, the Equilibrium Growth Portfolio has a 7-year horizon. Its value at risk target is -10%, which means there's only a 5% chance that the portfolio can lose more than 10% over any given year. If we stick to the portfolio's SAA, it's got a 70% probability of delivering CPI plus 4.9% over any given 7-year period, a 60% probability of delivering CPI plus 5.7% over any given 7-year period, and a 50% probability of delivering CPI plus 6.9% over any given 7-year period. It's a portfolio designed for investors with a longer term horizon and that have a greater willingness and ability to stomach larger short-term drawdowns. Lastly, the table here shows the optimal SAAs for the 3 equilibrium portfolios. And as can be seen, our SAAs include a diversified mix of cash, bonds, property, and equity, both locally and globally. Each asset class adds value to the ability of the portfolios to deliver on their respective outcomes. The equilibrium conservative portfolio has a 38% strategic allocation to equities, locally and globally, and a 29% strategic allocation to total offshore assets, while the equilibrium growth portfolio has a 72% strategic allocation to equities, locally and globally, and a 42% strategic allocation to total offshore assets. An important point to make here is that in deriving these SAAs, we've utilized more than 80 years of financial market returns history, which includes many periods of crisis where the world felt like it was ending. We also use a technique called Monte Carlo simulation, which generates multiple versions of history and not just the one that we've actually lived through. It captures tail risk events that haven't occurred yet but could potentially occur. So the SAAs you see here are extremely robust and capable of delivering on our investment outcomes through many market environments, even through times of war. I'll now hand over to Herman van Papendorp, who will communicate where we're seeing both the risks and opportunities from a TAA perspective against a backdrop of heightened geopolitical and economic uncertainty. Thank you very much.
Thank you, Carl. Hello, everybody. I'm Herman van Papendorp, Head of Asset Allocation at Momentum Investments. Welcome to our chat about financial markets and asset allocation. When financial markets experience severe sell-offs, as they did in March, maintaining perspective is essential. So let's now discuss how markets have historically responded to geopolitical oil shocks. The Iran war has understandably unsettled markets, primarily through higher oil prices and renewed inflation concerns. If we look at the historical oil price behavior after major geopolitical shocks, a consistent pattern emerges. Oil prices tend to spike sharply, but crucially, these moves have typically reversed within about 6 months. Even in more extreme cases, such as the Gulf War in 1990 or the Venezuelan oil strike in 2002, prices normalized within months. Equity markets show a similar pattern. This chart from UBS illustrates that in the absence of a US recession, equity market drawdowns during geopolitical oil shocks have usually been modest and temporary. Median drawdowns have been around 5%, with a maximum decline of 15%, while the US equity market typically recovered to pre-shock levels in roughly 5 months. So the key question for investors is not whether geopolitical shocks create volatility and near-term downside risks, they always do, but whether they fundamentally derail economic growth, particularly in the US. At this stage, while risks have clearly increased, the US economy at least entered the conflict with solid momentum. Furthermore, prior interest rate cuts and ongoing fiscal support mean the balance of probabilities still favors slower but positive growth, rather than an outright recession. History tells us that over a 1-year horizon and beyond, asset class returns are driven far more by fundamentals, valuations, earnings and policy than by geopolitical events themselves. That brings us to the global macro and asset allocation environment. When we look across global asset classes, we continue to see equities as more attractive than bonds. There is an important shift taking place in 2026. Fiscal policy is turning growth supportive across many large economies. After a negative fiscal impulse in 2025, governments are now adding stimulus, which is historically favorable for earnings and risk assets, while fiscal deterioration is fundamentally negative for global bonds from a supply perspective. At the same time, most major central banks remain in easing mode. While rate cuts have been delayed by inflation concerns linked to higher oil prices, the broader monetary cycle is still supportive for global equities. This backdrop is already feeding through into earnings. This slide shows that profit growth in 2026 is becoming more synchronized across regions. Unlike 2025, when growth was very uneven, consensus expectations are for positive earnings growth across both developed and emerging markets. In the US specifically, earnings momentum has broadened significantly. Strong performance is no longer limited to a handful of mega cap stocks. This improvement in market breadth is a healthy sign for the equity cycle. That said, not all equity markets look equally attractive. Developed market equities, particularly the US, remain expensive by historical standards. Valuations are elevated relative to both history and to bonds. While strong earnings momentum can sustain such valuation premia for extended periods, expensive valuations reduce the margin of safety for investors and increase sensitivity to adverse surprises, whether from inflation, policy, or growth. DM equities are best characterized as offering reasonable but not exceptional forward returns, with elevated valuation risk partially offset by earning support and policy tailwinds. Another notable development has been the gradual diversification of global equity flows away from the US. In 2024, around 73% of global equity inflows were directed towards the US equity market, reflecting the dominance of the mega cap technology stock theme in markets at the time. So far in 2026, this figure has declined to roughly 26%, as investors increasingly allocate new capital to non-US DMs and EMs. This shift reflects an incremental redirection of new investment flows, driven by valuation concerns, political uncertainty, and the desire for broader diversification. This trend is likely to resume once near-term geopolitical concerns subside. Emerging market equities stand out as one of the most compelling global opportunities. Firstly, EMs are positive leverage to a weaker US dollar. Historical evidence indicates that US dollar bull and bear markets tend to be long-lasting and sizable. While the dollar has weakened since 2024, the magnitude of its decline remains modest relative to previous bear markets, and valuation measures suggest the dollar remains expensive on a real trade-weighted and purchasing power parity basis. Once the dollar likely resumes its weakening trend following the resolution of near-term geopolitical stress, EMs are likely to benefit both from improved capital flows and currency translation effects. The lagging EM-DM equity performance relative to the magnitude of US dollar weakness from 2025 suggests that this cycle is still in its early stages. Historically, EM-DM equity outperformance occurs over multi-year cycles following sustained dollar weakness, rather than the short-term outperformance seen from 2025. Secondly, earnings momentum in EMs is strong and improving, particularly in technology-heavy markets such as Taiwan, South Korea, and China. Importantly, EM equities are not merely a value trade, but also provide exposure to structural growth themes, including AI adoption. And thirdly, valuations in EMs remain attractive relative to developed markets, even after the pre-Iran outperformance. This valuation discount provides both downside protection and scope for re-rating once global risk sentiment improves. Taken together, these factors lead us to maintain a large overweight position in EM equities within global portfolios, particularly for investors with a 1 year or more horizon and tolerance for short-term volatility. Global government bonds face a challenging environment. Higher oil prices raise inflation risks, while widening fiscal deficits increase bond supply. In the US, a significant proportion of outstanding government debt is also set to mature within the next year, exacerbating refinancing needs and supply pressures. In recent geopolitical episodes, bonds have failed to offer consistent portfolio protection as inflation concerns outweighed flight to safety flows. Furthermore, from a valuation perspective, global bonds outside the US appear expensive relative to equities. While US bonds trade at a rare discount to US equities, the absolute level of yields offers limited real return potential given inflation uncertainty. As a result, in our view, global government bonds warrant an underweight stance within asset allocation provided the US doesn't experience a recession. We think US cash currently offers a somewhat better alternative to long-duration fixed income exposure, as expected returns are similar, while cash provides capital protection and optionality in an uncertain geopolitical environment. Nevertheless, real global cash returns are also modest and as such justify an underweight asset allocation positioning relative to global equities and most South African asset classes in our view. Global listed property sits somewhere in between equities and bonds. While sector fundamentals have improved in areas like industrial and retail property, valuations remain stretched relative to bonds. Although global listed property offers income and diversification benefits to investment portfolios, we think its sensitivity to potentially higher fixed income yields and inferior risk-reward potential to other assets support a moderate underweight position in a diversified portfolio. Now let's turn to South African assets, which we think offer standout investment opportunities. South Africa entered 2026 with improving macro fundamentals relative to recent years. While absolute economic growth remains modest, the direction of travel is positive. GDP growth has accelerated from 0.5% in 2024 to above 1% in 2025, with expectations of further improvement in 2026. This positive growth delta is supportive of SA risk assets, particularly equities and listed property. In addition, contained local inflation, a downward albeit delayed trend in interest rates, and fiscal improvement also underpin SA nominal bonds. Importantly, SA asset prices still embed substantial risk premia, reflecting years of political, fiscal, and structural uncertainty. As these risks stabilize or recede, even modest improvements in fundamentals can drive meaningful re-rating and attractive real returns. South African equities are particularly compelling. Firstly, this chart shows that forward PE valuations are exceptionally attractive relative to history. Even assuming conservative earnings growth, the market trades well below long-term averages. SA equities also offer superior dividend yields and one standard deviation cheap forward PEs relative to EM peers, enhancing total return prospects. Secondly, earnings growth is expected to improve, supported by lower interest rates and operating leverage. Thirdly, ownership dynamics are favorable. Local institutional investors have materially reduced SA equity exposure over the past decades to fund offshore diversification, and this selling pressure has largely now run its course. At the same time, foreign investors remain underweight SA within global emerging market portfolios. Recent inflows into SA equities in early 2026 signal renewed offshore interest, as shown in the blue bars on this chart. Initially concentrated in gold counters, foreign buying has broadened to include SA-focused companies, particularly banks. Although short-term selling pressure has emerged in response to the global risk aversion in March, structural under-ownership suggests scope for sustained global inflows once geopolitical volatility subsides. Although SA equities can be volatile during global risk-off periods, this also creates substantial upside during recoveries. On balance, we maintain a moderate to large overweight position. Due to the Iran-related sell-off in March, SA nominal government bonds now offer more attractive real yields by both historical and global standards. Part of the current yield premium reflects the prevailing global risk-off environment, while improvements in local fiscal metrics and investor confidence have narrowed risk premia from the 2024 national election highs, without fully eroding forward return potential. Foreign investors have been consistent net buyers of SA bonds throughout 2025 and up to the Iran war in 2026, attracted by high real yields and the country's improving macro stability. Although nominal yield spreads to the US bonds have compressed, real yield spreads remain attractive. With inflation expected to predominantly remain within the inflation target band, and the SA Reserve Bank likely to resume its cutting cycle once there is more certainty about the impact of the war in Iran on local inflation via the oil and currency transmission mechanisms, nominal bonds offer scope for capital appreciation in addition to high carry. In our view, this supports a small overweight allocation to SA nominal bonds. In contrast, SA inflation-linked bonds offer less appeal. Break-even inflation rates are unlikely to widen meaningfully, given the expected broadly sideways inflation trajectory to the end of 2027, while accruals are low relative to history. As a result, ILBs offer lower return upside compared to nominal bonds. Similarly, while SA cash still offers decent positive real returns above long-term averages, potential returns have declined from 2024 highs as interest rates fell. Although cash has a liquidity and capital preservation role to play in portfolios, it is currently inferior as a return-seeking asset in our view. SA-listed property is another high-conviction opportunity. Sector fundamentals have improved markedly, particularly in the retail and industrial subsectors. Limited new supply, declining vacancies, and rising rental reversions support earnings growth, while falling interest rates reduce funding costs, and solar installations drive improved margins. The office sector remains challenged, but shows early signs of stabilization, supported by a return to office trends, ESG upgrades, and demand growth from business process outsourcing. Although recent listed property results have surprised to the upside, and companies have increased their forward guidance, valuations remain depressed, reflecting years of pessimism and elevated yields. As funding costs decline and earnings recover, the sector offers attractive income and capital growth potential. We think all these factors validate a large overweight position to South African listed property. Finally, gold deserves specific mention. Since 2022, gold prices have remained elevated despite higher global real yields. The key driver has been strong central bank demand, particularly from emerging markets, as central banks have been seeking to diversify reserves away from the US dollar amid concerns about financial sanctions and the weaponization of currencies. However, EM central banks still hold relatively low gold allocations compared to developed markets, suggesting ongoing structural support for gold prices. More recently, gold buying by exchange-traded funds due to strong inflows from 2025, and even gold buying by the stablecoin provider Tether, which was the largest non-sovereign buyer of physical gold in the fourth quarter of 2025, holding more gold at the time than the SARB, have accentuated previous price appreciation and added volatility to gold prices. However, it needs to be acknowledged that these speculative positions by weaker gold holders are more likely to reverse during periods of risk aversion like the current Iran conflict, with negative short-term impacts on the gold price. Gold provides valuable portfolio diversification benefits. It has a low correlation to equities and bonds and has historically performed well in rand terms. While short-term volatility is always possible, the strategic case for gold remains intact, supporting a moderate overweight position. So, let's summarize our investment thinking in 4 points. Firstly, fundamentals, valuations, and policy remain the dominant drivers of investment returns. In this environment, we continue to favor equities over bonds, emerging markets over developed markets, and South African assets over global peers. Secondly, while geopolitical events like the Iran war create uncertainty and volatility, history shows they rarely derail medium-term investment outcomes. We always viewed well-diversified and carefully constructed portfolios with exposure across a broad range of asset classes as the most effective safeguards against uncertainty and volatility associated with geopolitical shocks. Thirdly, market declines are uncomfortable, but they also create opportunities. Sharp price declines allow investors and portfolio managers to add exposure to asset classes at more attractive levels where this is fundamentally justified. This principle is captured in the well-known investment maxim most commonly attributed to the 19th century British financier Rothschild to buy on the sound of cannons, sell on the sound of trumpets. Fourthly, for investors, adherence to clearly defined and rigorously constructed investment objectives is critical to preserving long-term outcomes. Provided those objectives remain unchanged, maintaining portfolio positioning through periods of stress is often both sensible and appropriate. Historical experience consistently shows that reactive portfolio selling during periods of market stress erodes long-term value by locking in losses ahead of the recoveries that markets typically deliver. In many cases, inaction proves to be the optimal strategy. Thank you for watching, and remember to stay invested through time.
Thank you, Carl and Hammer. Lastly, but certainly not least, we move to our colleague in London. Please welcome Jade Koish, a senior analyst from our London office, who will give us feedback on the global model portfolios.
Thank you so much, and thank you everyone for joining us. Now to speak about the global portfolios. I'd like to just set the scene by outlining some key macroeconomic drivers that we saw during the first quarter of 2026. Now, coming into the year, we saw expectations of positive growth across most developed markets and also emerging markets as well. You can see from this table here that the expectation generally was that we were going to see an uptick in growth in 2026 compared to the growth that we experienced in 2025 across most developed markets. Not all, but most, and also in emerging markets as well. So we generally entered the year with optimism. Investors were broadly bullish. The expectation was that we were going to see an extension of that bull market go through to the end of the year. And we broadly saw that reflected in performance numbers in January and February as well. So you can see here that gold did perform phenomenally well in January and February. We also saw very strong positive returns coming from emerging market equities, and then developed market equities and global bonds as well. You know, not shooting the lights out, but still in positive territory at the beginning of the year. Then came the 27th of February and the war in Iran began, and markets took a tumble through March. All of the returns that were made in January and February, unfortunately, were more than lost in March. We even saw this in the case of gold, where, phenomenal performance at the beginning of the year, but, this usually safe haven asset, in fact, fell significantly in March. It did, in fact, still end the quarter in positive territory, but that's because of the positive performance at the beginning of the quarter. In April, you can see here we've experienced a very strong rebound. We're still continuing to see that coming into May, but that is a story for next quarter. Now, taking a look at the underlying sectors, you can see here that underlying sectors generally, again, were doing well in January and February. And then when the war in Iran began, every single sector, except for energy, in fact, underperformed until the end of the quarter. And, that was very severe underperformance. And the reason for this, of course, is, the concerns around rising geopolitical tensions, the fact that there are likely to be energy price surges as a result of the war and the closure of the Strait of Hormuz. And then also we have inflation concerns resurfacing as a result of that as well. Now, there's still a lot of uncertainty in markets, particularly, as negotiations are still ongoing and Strait of Hormuz remains closed. So 20% of global oil, in fact, passes through the Strait of Hormuz, and also a lot of other goods also pass through the strait. For example, 25% of the global supply of fertilizer runs through Strait of Hormuz, and this is going to have and has had a huge knock-on effect to both the availability and price of goods and services. So not only is it already more expensive to fill up our cars, this is always also going to have an impact on things like the cost of flights or even, the availability of flights. For example, the ability of farmers to grow crops because the access to, 25% of the global supply of fertilizer is being restricted. And all of this will feed through into the input prices for both goods and services. And what does that all result to? The fact that we are going to see upward inflationary pressure in many areas coming through, which we started to see already, but we're certainly not out of the woods. Now, looking a little bit more at the oil price, in March, the oil price, in fact, reached a level that we haven't seen since Russia invaded Ukraine. But then the oil price, in fact, came back quite significantly before the end of the month was out. And we've seen the oil price rise again in April. So we're seeing a lot of volatility, not just in the oil price, but just in general. And as mentioned, we're not out of the woods yet. There's negotiations are still going on. There's still a lot of uncertainty. And the expectation is that we, are going, the severity of the situation only increases the longer we had uncertainty carries on. And you can see here from this chart, the longer the conflict goes on, the longer the Strait of Hormuz stays closed, the bigger the impact on prices are likely to be globally. And this is particularly true of the UK and Europe, who are particularly dependent on both oil and gas imports. In the US, they are self-sufficient when it comes to energy. However, they are not completely immune. They will also experience an increase in the price of energy in the US because, of course, if global supply is restricted, then the energy price goes up for everybody globally. The US is also maybe a little bit more cushioned from the conflict in Iran because just geographically, the country is further away from the conflict than, say, the UK and Europe are. So again, this reignites inflation concerns, which had somewhat stabilized, although at a slightly higher level than those kind of pre-COVID lockdown levels. But it had stabilized, and now we're starting to see some of those, inflation concerns creep back in. And of course, this is coming through and feeding through into interest rate expectations. This means that, given that we're seeing inflation concerns coming back, markets are no longer expecting interest rate cuts, which they were expecting at the beginning of the year. Just at the 1st of January, the expectation was that in the US and the UK, we were going to experience rate cuts during 2026, and it was likely that Europe was going to hold rates steady. However, roll forward just 3 months, and the expectation now is that the US is not going to cut rates at all. The Eurozone and the UK are both expected to hike rates this year. So that's a huge differential in just a 3-month time frame. Now, we obviously agree the narrative has certainly shifted, but we question whether we are likely to see this level of interest rate hikes that the market is pricing in at the moment. So again, there's still a lot up in the air, but the world looks very different now than it did in a post-lockdown, post-COVID world. Post-lockdown, there was a huge persistent demand force coming out of that period where, consumers had a lot of cash to spend. However, the situation today is that this is a supply side shock where the supply is being restricted and we don't have those same demand forces in play. Turning our attention to 2 asset classes, which we typically view as safe haven assets. So we've got the US dollar on the left, and then we've got gold on the right there. So after a period of underperformance, the US dollar, in fact, did fulfill this role of being a safe haven asset during the market fall in March. And you can see that from the graph on the left there, that when the conflict in Iran began, the US dollar actually did outperform and investors sort of flocked back to the asset. However, on the right-hand chart, you can see there that gold, in fact, behaved more like a risk-on asset class, which is quite unusual, especially because it's seen as safe haven asset or an event risk hedge typically in portfolios. But for me, what this really highlights is that the price that you pay for an asset is very important, because if something is expensive enough, when markets sell off, and investors take profit, that asset class is likely to fall. And that's what we saw with gold in March. Again, overall, gold was still up for the quarter, despite that sell-off in March. But but it didn't sort of hold the same characteristics we would usually expect from that asset. Okay, let's talk about the portfolios. This slide here is just a reminder of the asset class makeup of the 3 different portfolios, offering, first of all, on the left-hand side of your screen there, a lower risk portfolio, which I will refer to as a cautious portfolio. And that has an asset blend of about 30% in equities and 70% in fixed income and diversifying asset classes like gold and real assets, for example. Then we have the medium risk profile in the middle there. So I'm going to refer to this as a managed portfolio. And the asset class makeup of that portfolio is about 60% in equities and about 40% in fixed income and diversifying asset classes. And then lastly, on the right-hand side, we have a higher risk portfolio, which I'm going to refer to as the growth portfolio. And that has about 90% in fixed it. Sorry, it has 90% in equities and 10% in bonds and diversifying asset classes. So looking at long-term performance, you can see from this slide that the 3 portfolios have outperformed their cash plus targets over the longer term. So that is the solid lines relative to the dotted lines just underneath. You can see that negative impact from March performance there at the end. This is short-term performance. We are going to experience periods of underperformance, throughout the lifetime of these portfolios when we see those, market downturns. But the intention is that these are short-term periods, and over the long term that will wash out, and performance should be positive relative to the cash targets over the longer term. This next slide is the same performance, but just in ZAR terms. And you can see 3 portfolios again have outperformed their cash plus targets, but the performance numbers are higher, and that's because of that currency impact. Now, zooming in a little bit on particular periods of performance here, you can see that over the recommended holding periods for the 3 different portfolios of 3, 5, and 7 years, outlined in those black boxes. So first of all, the cautious portfolio at the top there. This portfolio has performed ahead of both its target and also the peer group in its recommended holding period. The managed portfolio, which is at the middle of the table there, this portfolio is ahead of its peer group, but is lagging its target over that 5-year time horizon. And the reason for this is because of predominantly that 2022 performance. And this was a particularly tough year where both equities and fixed income underperformed. So relative to a cash plus target, which by nature is going to be positive, that relative performance differential was a bit bigger. And this performance is having quite a big impact on that 5-year number relative to that cash plus target. But again, that is 1 year of performance, and the hope is that over time, that performance will improve. When we look at the growth portfolio, which is at the bottom of the table here, performance is broadly in line with the peer group and also broadly in line with that performance target as well. Looking at performance during the first quarter of 2026, all of the portfolios were ahead of their peer groups, but they underperformed their targets, which is unsurprising, given the severity of that market fall in March, and given that a cash plus target, again, is going to be in positive territory. But relative to peers, we have managed to outperform. So, showcasing that active management, is obviously a little bit more, it was a bit more difficult in March. If we focus a little bit more in terms of quarterly performance, this next slide here shows the performance of the cautious portfolio, which has a 3-year time horizon. For the performance in Q1 relative to a 30-70 equity bond benchmark, the portfolio actually outperformed marginally. And the reason for this was predominantly because of asset allocation. That was a contributor to performance, particularly that underweight to equities, but also the asset class mix within the fixed income portion of the portfolio helped. So in particular, the allocation to those lower risk bonds like treasuries and inflation-linked bonds as well. Unfortunately, manager selection was a detractor, and this is mostly due to a couple of equity managers within the portfolio, which I'll touch on in a little bit more detail later. So this is the medium risk managed portfolio, the relative performance to a 60% equity, 40% bond benchmark. And you can see the portfolio in the first quarter performed broadly in line with this benchmark. So again, it's the same performance drivers as the cautious portfolio on the previous slide. It was that equities underweight, which helped performance. And again, those the allocation to those lower risk bonds, which also helped performance as well. And then in the detracting side, we have manager selection due to a couple of those equity managers that were down, particularly during March. Now, the effect from that is higher in this portfolio because the equity allocation is higher than in the cautious portfolio on the previous slide. Lastly, we have the higher risk growth portfolio. So relative to a 90% equity, 10% bond benchmark, the growth portfolio was broadly detracted and underperformed by about 1%. Again, asset allocation additive, but the manager selection impact, again, is a bit more severe for this portfolio because it does have that higher allocation to equities, and that's what's driven the underperformance here. Now we delve a little bit deeper into what worked and what didn't in terms of performance during the first quarter. You can see here, so again, that asset allocation positioning helped performance, so the underweight to equities, but also the slight overweight to cash really helped all three portfolios during the first quarter, particularly in March. In terms of manager selection, again, it was mostly equities where that detraction came from. And it was in fact within the global equity fund, of course, so that both the quality and growth funds detracted quite significantly. On the other side of that, we have the conservative and the value equities funds, which contributed nicely. But unfortunately, the positive performance from those two portfolios wasn't enough to offset the negative performance from the quality and growth funds, which detracted. Now, within emerging market equities, we had negative performance coming from the Coronation Emerging Market Equity Fund. But on the positive side, we had the Fidelity Emerging Market Fund. And that contributed because it has quite a few commodities-related stocks within that portfolio. And that, of course, helped performance, particularly because energy did so well during March. And that helped the relative and absolute performance of that fund. When we look at the cautious and managed portfolios and those fixed income allocations within those two portfolios, the Standard Global Aggregate Bond Fund was the main detractor. There's a higher allocation to higher risk bonds like emerging market debts within that aggregate bond fund, and that is why that portfolio underperformed during Q1. On the positive side, we have the Coronation Global Strategic Bond Fund. This has a higher allocation to developed market and inflation-linked bonds, so they're sort of lower risk assets, and that's why that fund performed quite well. So generally a mixed quarter for our underlying funds. Generally, defensive assets did pretty well and riskier assets underperformed. Nothing too surprising there, given the downturn. Performance was entirely driven by the market fall in March. At the end of January, February, we actually were in pretty good shape. And then coming into April, of course, we've seen, that market rebound, which, of course, the portfolios have participated in. This slide here just shows underlying manager performance, which we talked about on the previous slide. You can broadly see, again, defensive assets have done quite well, whereas risky assets have done a little bit worse, given market conditions. And just to end on current positioning and our asset class views, coming into the second quarter of 2026, markets have rebounded very strongly following that sharp fall in March. And this really highlights that risk on, risk off pattern that we're seeing in markets. Generally in this environment, our strategy is to remain broadly invested, maintain diversification within the portfolios, and then deploy cash quite selectively when we see an interesting opportunity arise. In terms of current positioning, you can see our asset class views here on the slide. But broadly, we're slightly overweight fixed income and we're slightly underweight to equities. Within our equities allocation, we are underweight the US and we're overweight other regions where we think valuations are quite depressed. So for Japan, for example, stylistically, we're overweight quality and smaller caps, and we are underweight growth. So that's all from me today. Thank you very much for listening.
Thank you, Jade. That wraps up our quarterly bulletin for the day. Thank you for spending time with us today and for your continued support. We truly appreciate the ongoing engagement and hope the ideas and insights shared were both useful and relevant for you and your clients. If any questions come up, or if you'd like to chat further about how our solutions can support your advisory practice, please feel free to reach out to us anytime. Our investment specialists and our portfolio managers are always happy to help. We look forward to connecting again next quarter. Until then, thank you once again. Take care.